Have you ever found yourself making the same missteps in trading despite knowing better? Today, we're diving into those pervasive errors that many of us encounter at some point in our trading journey. Let me be clear from the outset. This discussion isn't about assigning blame to anyone. In fact, I've personally stumbled through most of these very same pitfalls myself over time. It's a truly universal experience. Nearly everyone who ventures into trading has faced these challenges, and that's perfectly normal. However, understanding the underlying reasons for these recurring mistakes and truly seeing what drives them makes overcoming them far simpler. Consider the official data from CFD and forex brokers, which they are legally obligated to disclose. These reports consistently show that between 74% and 79% of retail accounts end up losing money. This isn't just an assumption. It's a verifiable fact backed by regulatory statistics, not just an opinion. Therefore, we're not discussing an isolated issue, but a widespread predicament that affects a significant majority of traders. My goal for today is for us to collaboratively explore the deeper why behind these common occurrences. We'll be examining 5 distinct categories of mistakes that frequently surface, not only in my own trading, but also across extensive research and the collective experience of traders everywhere. The initial category we'll tackle has absolutely nothing to do with market charts or sophisticated strategies. Instead, it's intrinsically linked to our own cognitive framework and how our brains are fundamentally predisposed against us when it comes to making trading decisions. Following that, we'll delve into the psychological traps that ensnare us, the behavioral patterns that deplete our funds, and even how the very structure of the trading environment can steer us astray. Our final category, though perhaps a bit unexciting, might honestly be the most crucial element of the entire trading puzzle: proper position sizing. Towards the conclusion of this video, I'll reveal the personal steps I've taken to specifically address these common mistakes. First, however, we must grasp the root causes of these issues, because a complete understanding naturally makes solutions apparent. So, let's begin with the insight that genuinely surprised me, a fundamental aspect most of us rarely consider. Our brains, the very hardware making our decisions, were never engineered for the complexities of trading. Their primary design was for survival, evolving for tasks like escaping predators, locating food, and avoiding immediate physical danger. While this might seem like ancient history, the problem arises when a trade moves against us. Especially with real money and leverage, our brain responds to that loss remarkably similar to a physical threat. The actual neuroscience is far more complex, but simply put, our emotional responses often override logical planning. This emotional dominance alone is sufficient to severely impair our decision-making capabilities. Have you ever had a trade turn unfavorable, causing your entire carefully constructed plan to vanish instantly? You might find yourself frozen, unable to act, or perhaps you panic sold at the absolute worst possible moment. This isn't a personal weakness, it's your brain performing exactly its designed function. It's attempting to protect you from what it perceives as an immediate and significant threat. What's truly fascinating is that brain scans reveal experienced traders process risk in a fundamentally different way. This distinct processing is a result of their brains undergoing extensive conditioning through constant, repeated exposure to market pressures. While the fear response persists, it no longer dictates their choices, unlike how it overwhelms novices in the trading world. It's crucial to grasp that our brains aren't inherently flawed or malfunctioning in these situations. Instead, they are simply operating with ancient, survival-oriented programming within a very modern, complex environment. Acknowledging this fundamental truth allows us to cease self-reproach for our emotional responses. These reactions are universal. They are deeply ingrained, an inherent part of our human design. Yet, this biological wiring is merely the initial layer of complexity we face. Beyond our innate biology, a complete array of psychological pitfalls is ready to influence our decisions. Considering our brains are fundamentally wired for survival, let's explore how this impacts our actual trading decisions. This brings us to a highly relatable concept from behavioral economics known as loss aversion. Seminal research reveals that the distress from a financial loss is approximately twice as intense as the satisfaction from an equivalent gain. To put it simply, experiencing a $100 loss feels significantly worse than the positive sensation of earning $100. Reflect on how this dynamic affects our trading. Imagine gaining $200 on a single trade. That feels great, doesn't it? However, if the subsequent trade results in a $200 loss, despite being financially even, it doesn't emotionally register as break-even. Instead, it profoundly feels like a loss, and this inherent emotional imbalance fundamentally shapes our entire trading perspective. When holding a profitable position, a sense of anxiety often creeps in. We feel compelled to secure those gains quickly, fearing they might vanish. This often leads us to exit winning trades prematurely, cutting short potential larger profits. Conversely, with a losing trade, we tend to cling on, convincing ourselves that a recovery is imminent. We often hold out, hoping to at least reach our initial entry point, because the thought of realizing an actual loss is simply too painful to accept. This isn't merely a theoretical concept. It's a widely observed and extensively documented pattern in the world of trading. We frequently close our profitable positions too soon, yet allow our losing ones to continue deteriorating. It's a habit many, if not most of us, fall into at some point. The situation can escalate further. As the market persistently moves against our open losing position, our minds employ a subtle trick. Our brain begins actively seeking out any information that supports our initial belief, trying to confirm that we made the correct decision. We might disregard the actual price movements, instead scouring social media for anyone, literally anyone, who validates our market perspective. Unconsciously, we find ourselves adding more funds to a trade that's already unprofitable, essentially averaging down into a deeper hole. If you're currently nodding in recognition, rest assured, this is a common experience shared by many traders. However, this pattern of behavior doesn't end here. It often leads to even more detrimental outcomes. Our brains are inherently programmed for fear, and our psychological tendencies drive us to hold on to losing trades while quickly selling off winners. This combination alone presents a significant challenge for any trader. But when we layer additional behaviors onto this foundation, the situation can truly spiral out of control. Let's begin by discussing the concept of FOMO, or the fear of missing out, where we often observe a substantial market movement unfolding. If this scenario sounds familiar, don't worry, it's a trap many traders have experienced. However, this detrimental pattern often escalates, leading to even more damaging trading behaviors. For instance, we might witness a rapid market surge, perhaps a cryptocurrency or stock, suddenly jumping 30%. Despite having no prior plan or setup for such a trade, we impulsively decide to enter the market. This hasty decision stems from the fear of missing out on potential gains, which feels worse than the risk of a poor entry point. The unfortunate truth is that these fear of missing out trades almost invariably occur at the least opportune moments. We typically buy in after the significant price movement has already happened, entering purely on emotion without a plan or stop loss. Consequently, we often find ourselves on the losing side, purchasing assets at inflated prices while others are securing their profits. When such a trade, or any trade, goes wrong, it can trigger an even more perilous reaction: revenge trading. We feel personally wronged by the market's outcome and are consumed by an urgent desire to reclaim our lost money. This leads us to increase our next trade size, bypass crucial analysis, and hastily open another position, hoping for an immediate recovery. Yet, revenge trading rarely succeeds because it's driven by raw emotion rather than sound, logical decision-making. One bad trade quickly snowballs into several, and suddenly our account balance plummets, not due to a flawed strategy, but from abandoning it entirely. Many of us have faced that late-night moment, desperately convincing ourselves a losing trade will rebound, only to make another desperate, ill-advised trade instead of cutting losses. The next morning, we often find we've squandered more capital in a few panicked hours than during an entire week of disciplined trading. This brings a stark realization. The real damage isn't inflicted by market fluctuations, but by our own emotional reactions to them. Yet, there's a crucial aspect of these experiences that is rarely discussed or openly acknowledged. These common behaviors, like FOMO, overtrading, or revenge trading, are not simply personal character flaws. Instead, they are deeply ingrained, predictable human responses to specific, high-pressure situations. By understanding when these reactions are likely to surface, we gain the power to prepare for and mitigate them. This fundamental shift from merely reacting to actively anticipating can genuinely transform our entire trading approach. Up to now, our focus has primarily been on internal factors, our brain's wiring, our psychology, and our personal behavior. However, it's equally important to acknowledge and understand the significant external influences at play. Modern trading platforms, for instance, are meticulously and deliberately designed to encourage our continuous engagement. This includes constant push notifications about trending stocks and prominently displayed top movers sections. Even seemingly innocuous features like celebratory confetti animations when a trade is executed serve a specific purpose. These aren't neutral design elements. Studies confirm they can increase trading volume by over 5%. They are expertly crafted to activate the same dopamine reward pathways found in social media engagement or even slot machines. Social media, with its finfluencers sharing wins and predictions, creates a strong pull. It's hard to resist acting on these confident calls, even without risk management details. When we encounter confident market predictions from people we follow, it becomes incredibly challenging to resist the urge to act immediately. This often occurs despite our awareness that such calls rarely include essential details like risk management or proper position sizing. Crucially, research indicates that when individual investors flood into a stock due to influencer buzz, they frequently purchase at the worst possible moment. They typically buy precisely when the stock's price is at its most inflated, right before a potential downturn. Consequently, those who invested early secure their gains, while the latecomers absorb the losses as the market corrects itself. It's important to clarify that the aim here isn't to assign blame or to foster a victim mentality among traders. Instead, the true objective is to cultivate a deeper understanding and awareness of these market dynamics. By recognizing these influential forces, we can transition from making impulsive, reactive choices to more deliberate and conscious decisions. So, we are contending with our biology, psychology leading us astray, escalating behavioral patterns, and an environment amplifying it all. While this seems like a formidable challenge, the good news is that once we grasp the complete picture, we gain the ability to take effective action. Our path forward begins with something surprisingly straightforward, yet consistently overlooked by many participants. To be frank, the upcoming segment might not be the most thrilling part of this discussion, as it delves into numbers, percentages, and mathematics. However, if there's any single piece of advice in this entire video that could genuinely safeguard your trading account, it is this crucial section. Let's now address the vital concept of position sizing, because most of us primarily concentrate on the entry point, the setup, or specific indicators. Yet, the critical aspect of how much capital we risk on any given trade is frequently treated as a mere afterthought, leading to significant damage. Consider this scenario. Imagine managing a $25,000 trading account, adhering strictly to a basic rule, never risking more than 2% on any individual trade. This translates to a maximum risk of $500 per trade, meaning an astonishing 50 consecutive losing trades would be required to completely deplete the capital. Such a buffer provides an extensive margin for error, offering considerable protection against sequential losses. However, abandoning this guideline and risking 10% per trade could see your account value halved after merely 5 or 6 unsuccessful attempts. Recovering from such a significant drawdown then demands doubling the remaining capital just to return to your initial starting point. The arithmetic behind these capital reductions reveals a truly unforgiving reality. Fortunately, a more intelligent approach exists, dynamically adjusting your position size according to current market volatility. In periods of high market fluctuation, one would reduce trade size, while calmer conditions allow for slightly larger positions. This method ensures that the actual monetary amount at risk remains constant, irrespective of broader market movements or conditions. It's an adaptive strategy, much like modifying your driving speed to suit varying road conditions for safety and efficiency. This concept might appear deceptively straightforward, perhaps even a bit unexciting to some. Yet, it's crucial not to overstate its power. Effective risk management, by itself, doesn't automatically ensure profitable outcomes. Nevertheless, neglecting this fundamental aspect makes failure virtually unavoidable in the long run. The traders who endure and eventually excel in this field didn't do so primarily because of superior trading strategies. Their longevity came from prioritizing robust risk management above all else, securing their presence in the market. We have now covered the 5 critical areas, including the mind and psychological aspects. This allows us to scale our trades, keeping the dollar risk constant despite market fluctuations. It's much like adjusting your driving speed to match the prevailing road conditions. While this principle may seem straightforward, even unexciting, I must clarify that risk management alone isn't a silver bullet. However, neglecting this fundamental aspect makes long-term success virtually impossible to achieve. Now that we've covered the 5 core areas, mind, psychology, behavior, environment, and position sizing, it's time to ask, what practical steps do we take? We've delved into our brain's biases, psychological traps, behavioral errors, and the market's exploitative nature, alongside the importance of position sizing. So, what are the actionable steps? I'll share what I've personally found beneficial, though I'm still continuously refining my own approach. Consider this not a definitive lecture, but rather observations on practices that genuinely make a difference. The primary focus should be on understanding our own psychological landscape, and the simplest tool for this is journaling. Beyond mere trade statistics like entry, exit, or profit/loss, it's vital to document your emotional state. Ask yourself, how did I feel before this trade? Was I calm or impulsive? Was this a planned setup or a rash decision? Remember our earlier discussion on cognitive dissonance, where our minds seek to validate our beliefs? Journaling directly combats this tendency. By consistently tracking your emotional responses, certain behavioral patterns quickly become apparent to you. Once these patterns are identified, you gain the power to consciously intervene and change them. The second crucial element is establishing a clear trading methodology and steadfastly adhering to it. This methodology could involve price action, indicators, or order flow. The key is to select a single approach that resonates with you. After thorough testing to build confidence, commit to executing it with unwavering consistency. This means avoiding the common pitfalls of constantly switching strategies or impulsively moving from one indicator to another. True success doesn't emerge from flashy new techniques, but rather from the often boring discipline of consistent execution. The third and arguably most impactful realization I've had is the acceptance that any individual trade is inherently unpredictable. It's impossible to predict the exact outcome of any singular market position with certainty. However, when viewed across a larger sample of 50, 100, or even 200 trades, a sound method combined with diligent risk management clearly reveals its profitability. This understanding empowers us to stop futilely attempting to forecast the result of every single trade. We also learn to detach emotionally from individual losses, recognizing them as part of a probabilistic game. Instead, our focus shifts to consistent execution, meticulous risk management, and allowing the statistical edge to unfold over time. This profound shift, from needing to be correct on every trade to trusting a well-defined process across many, has been the most significant transformation in my trading journey. It wasn't about discovering a secret technique, but rather about releasing the compulsive need to be proven right on every single occasion. This fundamental insight is what I genuinely aim to convey to you from the very outset of our discussion. While these principles might sound familiar, the crucial distinction now is our deeper comprehension of why they are effective. They transcend mere generic advice, directly confronting the inherent biases and problematic behavioral patterns we've explored. The concepts themselves aren't complicated, yet their implementation is challenging because it requires rewiring deep-seated habits our brains naturally resist. If you're currently watching this and feel it's too late for you, perhaps having already lost an account or being in a significant drawdown, I have a crucial message. Such experiences are not unique. They are a common occurrence for many individuals in trading. The priority isn't the capital that has been lost, but rather the strategic steps we choose to take moving forward. From observing traders who've successfully recovered from substantial losses, I've noticed their comeback journeys typically begin with identical actions. The initial and vital step is to simply halt all trading activity. It's essential to step away and allow our minds to return to a state of calm, rational thought. Upon returning, the second key is to engage in trading with extremely small positions, significantly reduced from previous sizes. The aim here isn't instant financial recovery, but to restore self-assurance and confirm our ability to adhere to a disciplined trading process. It may seem surprising, but a multitude of renowned and consistent traders experienced similar account setbacks before finding their success. Let's be clear, not every individual who faces such a loss emerges more resilient. That is a harsh reality. However, those who do rebound invariably attribute their turnaround to finally embracing strict risk management, a discipline they previously overlooked. Therefore, if you currently find yourself in this challenging position, recognize that your journey is far from over. You've simply arrived at the critical point in this path where the majority of people decide to abandon their efforts. Yet, those individuals who choose not to give up often emerge from this experience significantly stronger and more skilled. This pivotal moment offers a profound opportunity for transformation, leading us to reflect on the core areas we've explored today. Even many highly successful traders first experienced devastating account failures before achieving consistent results. However, it's crucial to acknowledge that not every individual who faces such a complete loss manages to recover stronger. Yet, those who successfully navigate this challenge consistently credit one crucial change: a newfound, unwavering commitment to risk management. Therefore, if you currently find yourself in this very situation, understand that your journey is far from over. You've merely arrived at the critical juncture where the majority of participants choose to abandon their efforts entirely. However, those determined individuals who refuse to give up often emerge from this ordeal significantly more capable and resilient. With that in mind, let's bring our discussion to a close by briefly revisiting the 5 fundamental areas we explored today. These encompassed our innate survival instincts, the psychological pitfalls, repetitive behavioral patterns, the broader trading ecosystem, and appropriate position sizing. The core message isn't that trading is an impossible endeavor or that failure is our predetermined fate. Instead, the crucial insight is that these common errors are entirely predictable and stem from identifiable root causes. Once we gain clarity on these origins, we possess a genuine opportunity to approach things with a fresh perspective and make different choices. We aren't striving for absolute perfection, but rather for a heightened state of self-awareness. Every time we catch ourselves about to make one of these mistakes, even if we still make it, that awareness is a significant step forward. I genuinely value your input. Please share in the comments which of these pitfalls resonated most with you. Your insights truly help shape my future content. If this video proved beneficial, consider subscribing for more insights into trading mindset and risk. Thank you for watching. Take care, and I'll see you next time.